Hello and welcome. This is Inside India and I'm Amitoj Singh. These are your headlines. AI disruption fears continue to rattle investors. The Nifty could see further pressure as the index just struggles to break past 26,000. India also releases its first retail inflation print under its new revised data series, and it showed prices picking up, returning to the RBI's target range. Thousands of Indian farmers staging nationwide protests against the US-India trade framework, but India's trade minister defending the pact, saying a majority of Indian farm products were excluded. All right, let's get a check on Asian markets. The markets there opening lower on Friday thanks to the AI fears and disruption that AI is causing globally. Of course, as you see right now, it's more or less a sea of red, and the Nikkei particularly down about 0.7%, 0.75%. This after, of course, the S&P 500 fell for the third straight day. We're watching Taiwan very closely because there's been a trade deal with Washington getting signed with tariffs lowered on exports to 15%, on par now with Japan and South Korea. But the market there is closed till all the way till Feb 23rd for the Lunar New Year holidays. So we're watching also Australia down 1.3%. And of course, the Hang Seng down 1.68%. Singapore had its budget, so that's going to filter into the sentiment. We'll watch that very closely. Now, earlier still, but US futures at this point in time, let's get a look at what's happened there. It's looking like it's going to be a slight pickup. The S&P 500 and the Dow Jones will be interesting to watch at this point in time, though it's the NASDAQ that looking like it'll have the most positivity. Remember, Wall Street did end deep in the red overnight because of those fears that established firms would rely on software for their services will face increased competition. The tech-heavy NASDAQ, of course, as I said, the biggest loser on the Wall Street, down over 2%. The freight and logistics sector came into spotlight. It was the latest sector to face the AI fallout, seeing significant losses overnight. And our travel and transport reporter, Monica Petrelli, has been watching this space very closely and joins us for more on this. Monica, what's this about? What's going on?
Yeah, it's really fascinating because we can watch this sort of happening around the world. But what we see first was in the United States yesterday, the big logistics companies. I'm talking about RXO, C.H. Robinson, Expeditors International, all dropping. As you can see, they're closing the day for the most part, double digits there. Also, though, over in Europe, we saw shares of the Swiss company Kuehne + Nagel shedding 13%, and Denmark's DSV also dropping 10%. Now, Asian logistic companies, I've been watching that as the markets have been opening here, a bit more muted. We can see a lot of the companies here in Asia, especially in East Asia where the markets are open, a lot of the logistics companies opening down, but not too bad. And already, I've seen some of these already making its way up. So we can see Nippon Express there, probably leading the pack there in terms of shares dropping. But again, we've already sort of seen that sort of turn upward for the most part. Now that could change by the end of the day. Now, we are also seeing, you could say, well, what's going on here? What triggered this? Well, it was an announcement by a company called Algorithms Holding. This company said that its platform called SemiCab is able to increase freight volumes from 300 to 400% without adding a single headcount. Now, this is a very employee-heavy industry, so that's big news. Now, shares of that company skyrocket upon this news, up at one point yesterday 80%, but closing the day around 30%. This company, though, you likely don't know it, definitely not a household name. It made its name in karaoke machines, of all things, before it pivoted over to AI logistics back in 2024, went public at the end of that year, listing on the NASDAQ, but since then had trouble and has been in delisting territory for failure to maintain share prices, as well as keeping equity at the appropriate level for NASDAQ. So that, even though shares there are skyrocketing, they're still just hovering just above that dollar territory. Now, the interesting thing will be to see how Indian logistics companies respond to this. If they do it all, we'll be watching those big companies to see what happens when the market opens later in the show.
Well, that's exactly what we're focusing on right now. Thanks so much for that, Monica. Let's actually take a look at the markets. What are the futures indicating there? GIFT Nifty futures at this point in time indicating that though the market ended yesterday at 25,807, it's could potentially start or fall towards 25,710. But overall, we're going to watch how a couple of different developments take place. We've got the inflation data, the new data under the new series, how that's going to be something the market reacts to, positively, negatively, muted. That's a big part of what we'll be watching. The other aspect is, of course, that you have this AI sell-off in the US. We're watching that very closely. At this point in time, Gift Nifty futures clearly indicating that it's going to be slightly down. Remember, the big focus has been on two things yesterday in the market. One, financials reacting positively to the impact of AI on their industry. But on the other, you've had the IT sector, which has had a bad day, sliding 5.5% to a 10-month low on concerns of AI-linked disruption to the sector. Hindustan Unilever shares, they fell more than 4% after the company reported a 15% drop in quarterly profit as margin pressures offset improving sales growth. The consumer goods giant said profit from continuing operations fell more than 25 billion Indian rupees in the December quarter, with EBITDA margins narrowing to 23.3% after price cuts in its tea and home care portfolios. Total expenses rose 5% as the company faced stiff competition in fabric care from both startups and global rivals. And continuing with the trend of consumers and consumer goods, India's key inflation rate has now jumped to 2.75% in January from the 1.33% in December. But what makes this this particular data set particularly notable is that it is the maiden print under a revised data series that comes with an updated base year of 2024 from the earlier 2012. The new series has cut the weightage of food from 46% to 37% earlier, as food has been one of the most volatile components of the retail price index overall. The series has now been expanded to 358 weighted items from 299 earlier. Interestingly, the methodology upgrades have seen the ministry collect prices from e-commerce and digital platforms, including the likes of Amazon and Swiggy across 12 cities, and prices for OTT streaming services like Netflix too. And these prices also include airline tickets, which are being added along with a couple of other things like the rural house rent, which has also been added now for the first time. So quite an interesting mix. And that's why we have with us today Sakshi Gupta. She's a principal economist at HDFC Bank, tracking the developments since late last evening in India. Sakshi, thanks so much for joining us. We really appreciate you coming on. I want to start by just understanding, does the change in the CPI basket materially, and that's the key word, alter the outlook for inflation? And I'm talking in terms of consensus forecasts and monetary policy.
Right. Good morning. Thanks for having me on the show. Look, at this point, I don't think that the new series materially changes the outlook, at least for, over the coming months. What we had been anticipating earlier was that, there is this base effect in India that will start turning unfavorable. And as it is, inflation prints will start inching up. One of the other concerns has been that, we might see there is a probability that we might see an El Nino here or some weather-related disruptions in 2026. It's still not certain. But if that were to happen, there is, of course, some volatility on the food basket that could come through. Of course, in the new series, since, as you mentioned earlier, the weight of food is now reduced compared to the old series. So at least on that front, the volatility impact could be lower. I think one of the interesting things that comes out of this series, of course, is the core inflation that we track, that is excluding food and fuel. And there, as you mentioned, housing, especially for rural areas, and how they're also capturing it for urban areas, has been revised. So that is one thing that we will be closely watching out for. Currently, it seems to suggest that housing inflation is still very, very low at about 2% at the aggregate level. From a policy perspective, and looking at our forecast for this year, just to give you some numbers, on the new series, we are tracking inflation for FY26 closer to 1.8%, which is not very different from what the earlier series was telling us. And for next year, our forecast is close to 4.2, 4.3%. Again, very much aligned with what the central bank is currently, looking at, or is close to their target. So from a policy policy perspective, I don't think that this changes our outlook or expectation on what the RBI is going to do. I think that the RBI now is going to be in a long pause. They will focus more on liquidity. So the story on interest rates in India, at least for FY27, is that we remain where we are on the repo rate.
I want to dive a little deeper into what you said regarding food. The general perception is that the reduced food basket weightage will reduce headline volatility. But you kind of alluded to this. You said there is a potential risk, I think. But is there a risk that the change methodology for housing prices and also, and this is something we didn't talk about, the inclusion of pricing data from e-commerce websites, etc., will kind of offset that particular food impact?
Look, I mean, that is something that can happen. One of the things that, apart from the food and weather-related shocks that I spoke about, the other thing that I am looking at on the inflation side is what happens to, whether the increase in commodity prices that we are seeing globally, how that kind of filters through into, producers' cost, and then ultimately is passed on to the retail consumer. So if I think, and recently we've seen a number of companies talk about, the cost of production going up. So I think if those pass-throughs start filtering through, then you're right that on the core inflation front, because now the weight is higher, that increase could end up offsetting the cushion that we are getting on the food side.
Okay. And I want to also return to what you were mentioning with regards to the RBI. I think the question is no longer whether the RBI will cut or increase its rate, because the numbers that have come with this new series appear to be within the market's expectations. There was some concern that what would happen if this would be a three-handle inflation range. So I guess the question is, and that would have perhaps prompted the RBI to turn their commentary slightly hawkish. And so I want to understand your outlook on their commentary, because I think that's where the focus is and what this new series does to that.
Right. I think we're still a couple of policies away from the RBI turning hawkish in terms of their commentary around, inflation and growth. I think in this context, it'll be important to also see the new GDP series that will be released at the end of this month. But just tracking momentum across high frequency indicators, I think growth is holding up, but I don't think that we're looking at, at least the global risks settling down. I mean, you were just talking about AI and the kind of disruptions that are going on in the global market, etc. So at least I think for the coming two policies, I would expect the RBI to continue with its broadly growth supportive tone and focus on providing enough liquidity, because look, what's important is that they want to push through the transmission of the interest rate cuts that have already been delivered. So if they are prematurely hawkish, then I think you end up undoing what you did in 2025 in terms of interest rate cuts.
Yeah, that's interesting. I guess I just want you to give us a little bit more color on now that we have one of the two new data sets that we are expecting in this month, what that does to the second data set. If you could give us a sense of the GDP numbers, what that would look like now that we have this particular number.
And I mean, that's very difficult for anybody to, you're asking me an impossible question. But, one of the things that I can speak about is that last year, a lot of the data that we got on the real GDP side, right? So first half, real GDP estimated at 8% in India. A lot of that was, buoyed by the very, very low inflation prints that we were seeing. So there were deflator issues that were kind of pushing up the real GDP numbers artificially. I think in the new series, because they are also in the GDP series, because they are also changing the way they are calculating the deflators, I think that some of those numbers could start looking lower. And we'll have to wait for the data to come out. But at least on the deflator side, some of those issues, I think, will be sorted out.
The other concern is, and perhaps premature, because we're thinking about how the new basket now could result in higher inflation, headline inflation numbers than what we expected for FY 2027, perhaps, due to this new basket. What's your view on that?
Due to this new basket, I think we cannot certainly say whether the inflation numbers for FY27 necessarily will be higher or not. I think, as we discussed earlier, it will be a play of where the inflationary pressures are coming through. So, if it is only concentrated within the food basket, then of course, the volatility or the impact is lower. However, if there are more structural inflationary pressures building up, which are demand side led because demand is picking up, or it is because cost of production is going up, then of course we would think of upgrading our inflation forecast. On balance, my sense is that we will end up with a higher inflation prints because inflation print than what we are forecasting for FY27, because I think both on food and core the risk currently seem to be on the upside.
But for corporates, is this a return to more pricing power?
Absolutely. I think, if you think about nominal GDP growth, if you look at the consumption momentum, if you look at capacity utilization rates across a number of sectors over the last couple of months, it does seem to suggest that there will be a return of pricing power. And that's why I'm saying that, look, maybe there is a little bit more upside on the core inflation front because that pricing power will return, into the system.
Okay, that's good to know. I want to talk to you a little bit about the bond market and how it has reacted, will react. Since the budget, they've been on a kind of a one-way upwards movement. The market was perhaps preparing for a higher inflation number. And so this has seen the 10-year go down just a tad bit from 6.7 to 6.69. But what is your outlook on the bond market?
Right. I mean, as you said, there's been an initial reaction to this number, but I don't think that reaction will last. I think the market is in the bond market is currently focused on the demand and supply dynamics. And there we know that the gross supply coming into the market in FY27 is very high. Incidentally, yesterday, the RBI did announce a couple of switches for bonds, which will, for bonds that were maturing in FY27 with the government. And that's going to bring down the gross borrowing number. So we are estimating that for FY27, the gross borrowing number could be lower. So I think that could be a bigger news for the bond market to react to in the near term. Coming back to our view for FY27 for the bond market, look, you're at the end of the rate cut cycle now. And usually what we notice is that once the last rate cut is done, usually you start seeing yields go up. And on top of that, if you add this demand and supply, gap, particularly being worsened by the amount of state paper that is coming into the market, I think seems to suggest that the 10-year bond yield is going up. We are expecting that by the end of 2026, the 10-year bond yield should be closer to 6.97%.
Wow. Okay. Final question, just a little bit about the true cost of borrowing. Some consider this the primary concern. With these numbers, are real rates a concern for you, for the markets, and for the economy?
Well, the real rate at this point, look, your repo rate is somewhere at 5.25. Your inflation 12 months ahead, or at least 6 months ahead, should be closer to 4%. So your real rate is somewhere around 1.25, which I think is broadly comfortable or growth supportive. So I think we are gradually moving away from real rates being 2% or higher, and now 2026 will be a story where real rates would be more comfortable from the overall perspective of growth and inflation.
Okay, well, thanks so much. Sakshi Gupta from HDFC Bank with all that perspective. Really appreciate it.
Thank you.
Thank you. Now, India will buy more U.S. liquefied natural gas, but only at competitive prices. Petronet LNG's chief said on Thursday, Petronet is the country's top gas importer, and it says that New Delhi is seeking affordable energy as it looks to boost imports from Washington under that broader trade push. U.S. President Donald Trump recently cut tariffs on Indian goods and urged India to ramp up purchases of American products. India, the world's fourth largest LNG buyer, wants to raise gas to 15% of its energy mix by 2030. However, limited affordable supply has left many gas-fired power plants running far below capacity. Also, the pressure to buy more U.S. energy will come with Trump administration asking India to stop buying Russian oil. And we did write this particular piece, and you can check out CNBC's Inside India newsletter, which refers to the conversation around whether India has actually committed to not buying Russian oil. Despite the trade agreement, we haven't heard much from New Delhi about this. And you can, of course, read more about this India, US, Russia love-hate triangle in this week's newsletter on our website, cnbc.com. Coming up, Japan's SoftBank slumping today despite posting a robust report card, and its India investments have something to do with the profits last quarter. We'll dive into the details after this short break. Welcome back. We're watching the Nikkei. It's under pressure today amid the broader market declines. One of the, big companies we're watching is SoftBank because it is among the big decliners despite posting a fourth straight quarterly profit. And to talk about that and more, we have Lisa Kim joining us. What are the details, Lisa?
Yeah, Amitaj. So today's trading session, SoftBank Group is trading lower, and so is the Nikkei 225. Nikkei 225 is lower modestly, but SoftBank Group posted earnings last night, and its October to December quarter earnings came in at around 250 billion US, and that's net profit versus net losses it registered the year before. And it was able to register a net profit thanks to its big investments in OpenAI. So SoftBank's investments in that company totals roughly 35 billion US to date, and it's reportedly in talks to invest an additional 30 billion. And because of its exposure and significant investments in OpenAI, SoftBank Group is considered sort of a publicly traded proxy to OpenAI. And in fact, SoftBank Group is the second largest private shareholder of OpenAI after Microsoft. And some investors are becoming concerned about SoftBank Group's increasing investments to fund its AI ambitions. And so addressing this concern, SoftBank Group CFO Goto said in an earnings call last night that SoftBank Group will keep ready 2 years worth of bond payments at hand. And also with regards to additional OpenAI investments, Goto said that nothing has been decided, but that he believes that OpenAI will potentially be a leader in the race to AI.
Okay, so let's just link this to India because SoftBank has a sizable, set of investments in India. So give us details of that.
Yeah, Amitabh. So SoftBank realized roughly $7 billion from its investments in India to date, and its holdings of investments in India total roughly double that number. SoftBank had sold stakes in major Indian startups, including Flipkart, which is roughly the Amazon of that country, as well as the food delivery app Zomato. And a number of companies that SoftBank recently invested in have recently went public, boosting the company's portfolio in that country. Notable listings include Lenskart, which is an eyewear retailer, as well as Meesho, which is an e-commerce platform. So SoftBank Group founder and CEO Masayoshi Son has a penchant, or sort of has a track record of investing in leaders and companies that he believes in. And so something that I will keep in mind, having done this reporting, is that I'll keep track of whether Masayoshi Son invests more in India, given India's huge startup ecosystem and given how tech savvy and young that country is. And more investments to come, I'll keep an eye on. And outside of India, SoftBank Group has a sprawling portfolio of investments in AI and semiconductors. It has either shares of or ownership in companies such as UK chip designer ARM, and recently it bought ABB Robotics and Digital Bridge. And of course, in the States, SoftBank is one of the companies leading OpenAI's $5 billion Stargate project to build out AI infrastructure in that country. And that project is being led by SoftBank Group, Oracle, and among companies, that is. And I'll keep an eye on where SoftBank Group is headed and how it finances its massive investments in AI going forward.
Well, thanks so much for that, Lisa. There's a lot of interest in what SoftBank does in India, and we'll continue to come back to you for that. Remember, we do have an AI summit that's coming up, and I'm sure there'll be more focus on that. Thanks so much for that. Now, we're talking about AI in the next segment, AI disruption fears gripping Indian IT stocks as the country gears up to host that AI summit, positioning itself as a global tech leader. But is one industry's loss a gain for others? We will discuss all of that after a quick break. Welcome back. The Bangladesh Nationalist Party has won a landslide victory in the country's parliamentary elections, securing 209 seats and a two-thirds majority in the 300-member parliament. The vote, the first since last year's Gen Z-led uprising that ousted former Prime Minister Sheikh Hasina, is seen as a crucial step toward restoring stability after months of unrest. BNP leader Tariq Rahman returned to the country after exile of 17 years. He's known as the Dark Prince. He's pledged economic reforms and anti-corruption measures while urging supporters not to hold victory rallies. Hasina, now in exile in India, dismissed the election as a farce, saying it excluded her Awami League party and lacked legitimacy. We're watching Indian markets very closely at this point in time. We're counting down to the market open, which is about 15 minutes away. This is how we're shaping up. We're looking at 25,719, GIFT Nifty indicating that figure. But Nifty 50, remember, closed a little lower from the 25,900 or so to 25,807. We're watching the rupee losing strength against the dollar gaining. But it has been a very volatile situation from 90.12 all the way to 90.7, 90.8, and at this point in time, 90.68. We'll come back and understand a little bit more about whether there's been intervention from the central bank, which there have been reports of in the last couple of days. Now, local media reporting also saying that India's Defence Acquisition Council has approved an initial plan to buy 114 Rafale fighter jets from France's Dassault Aviation in a deal reportedly worth over $280 billion. This comes as the Indian Air Force's squadron strength has fallen to 29, well below the sanctioned 42, following the retirement of aging aircraft like the MiG-21. While India is pushing domestic production under Prime Minister Narendra Modi, including orders for nearly 180 Tejas Mk-1A jets from Hindustan Aeronautics, deliveries have been delayed due to engine supply issues at GE Aerospace. The Rafale proposal now moves to detailed commercial and technical negotiations between New Delhi and Paris. The reports also coming ahead of French President Emmanuel Macron's visit to India next week, where he's expected to attend the AI summit in New Delhi. Also, Brazil's President Lula da Silva is expected to be an attendee at the AI summit. Indian Foreign Ministry said the Brazilian leader will be on a state visit to the country from Feb 18th to 22nd. Lula will hold bilaterals with Indian Prime Minister Modi. The two sides will explore cooperation in agriculture, pharma and rare earths. Now, this AI summit in India comes amid a market sell-off on AI disruption fears and a rout in the tech names. We mentioned the weakness on the Wall Street just overnight as investors fled the tech and transport stocks. U.S. futures indicating this for now, that it's going to be just slightly positive. But remember, the S&P 500 was down. These fears also spilling over to the Indian IT services firms. The stock slumped more than 5% on Thursday, dragging the Nifty IT index to a near 10-month low. Heavyweights, TCS, that's Tata Consultancy Services, Infosys and HCL Tech all fell sharply, extending a sell-off that has wiped up about 13% of the sector since early February. Now, concerns intensified after the launch of Amazon and Google-backed Anthropic's new AI automation tool, raising questions over demand for labor-intensive IT services. The slump also weighed on broader markets, and it comes as India prepares to host that major AI summit, aiming to position itself as a global tech leader. But there's another flip side. The IT sector's loss was perhaps a gain in some sense for the financial sector in India. Bajaj Finance, ICICI Bank, Trent, SBI, Bajaj Finserv, among those gainers, and perhaps what the market took most note of was this particular statement coming from Bajaj Finance's managing director, Rajiv Jain. He said this during the company's Q3 earnings call. AI listened to 20 million calls, converted voice to text, and gave us actionable data. Text to data conversion happened for 5.2 lakh customers. As a result, we generated 100,000 new offers for which we did not have information earlier. So basically, the capability which existed in Q1 and Q2 has now been deployed in Q3, and that has resulted in incremental business generation, improving productivity. Now, we're going to be talking to our next guest. Vivan Sharan is partner at Coan Advisory Group. Vivan, thanks so much for joining us. I've known you for, well, several years. Thanks so much for this. There's the India AI Summit that's coming up in a couple of days. It's set to be hosted under the shadow of this crack that we are seeing in the AI story sparked by Anthropic tools, and how that could really impact labor-intensive IT services, which is really India's IT sector. So I want to understand, we do know that AI is taking over these core operations slowly of Indian IT companies. But from an industry readiness standpoint, in your view, The market perhaps losing confidence, but some say the fear is overblown. So where is India in this situation?
Thanks, Amitoj, for having me. India is in the throes of transformation. It's an interesting period because India has always been the driver of digital transformation across the world. Its IT services have enabled that, provided that. And now I suppose it's time to gaze inwards and look at the kinds of transformations that our IT services themselves require. So on the one hand, as you've already indicated, there are gains to be had across specific use cases in finance, health, education, where we are seeing increasing levels of deployments. And I would say it's still at a mass scale, it is still at a very pilot stage. So companies are experimenting with what different forms of AI, whether Gen AI or otherwise, mean for them and productivity. The IT services, there are two tracks going on. One is that everyone is in like skunk works mode. So trying to figure out how best to optimize different off-the-shelf as well as developed solutions within their companies. But on the other hand, also the very big challenge of upskilling is something that I'm seeing go largely unaddressed because the talent pool or the engineering pool in India is so wide. It's 5 to 10 million people, depending on how you count. And really, that pool is a fungible pool. It has been servicing, this entire gamut of IT services companies. And because it is fungible, there's also this question of who has the real incentive to upskill that pool of talent, which moves around from company to company. So I think IT leaders in India are still trying to figure that one out.
Yeah, the transition is very clear. We've been seeing that for some time. You mentioned allocation also. I just want to, because you talk to government quite often. You look at regulation very closely. India did have a tech-heavy budget. There's a renewed push in semiconductor mission 2.0 now, not 1.0. 400 billion rupees for electronics manufacturing, rare earth corridors in mineral-rich states. What does the budget indicate to you in terms of, is it demonstrating that India is serious about AI?
I mean, for a person who's been following technology markets for about 15 years, this is a radically different ideology that has crept into India's economic policy, where we've prioritized industrial policy around technology products, and technology infrastructure, and this time in a very, very overt manner. So we've given safe harbor from taxation claims on data center operations that are going to be servicing the rest of the world. We've also, as you mentioned, allocated a very large CapEx grant budget for semiconductors, all the way from design to foundries and fab and fabless alike. We've also doubled down on the budget for electronic components. And I think part of this is driven through vision, which is obviously nice to have long-term objectives around what we want our electronics landscape to look like, or manufacturing landscape to look like, because obviously we need to create jobs at scale, and that is one big area to harness. But it's also sort of informed by the increasing dependencies that we see in supply chains and the vulnerabilities and fragilities that engenders. India is all too acutely tuned in to those kind of frailties, particularly coming as it is from a vulnerable regional supply chain where it links backwards into ASEAN, China, and so on and so forth. And obviously, the Great Power Balancing Act has also fed into this. So we are trying to make the most of the technology transfer that is organically coming our way, because we're seen as the next big market after the Chinese market, but also because we don't want to be suddenly de-linked from any part of the supply chain that is reorganizing, reshoring, and so on and so forth. So we are seeing a mix of incentives and sticks being wielded for companies to try to be able to localize in India, or to be forced to localize in India in certain instances, particularly in critical components.
Okay, fascinating that you mentioned all of that, because my next question is, how much of the India AI Summit is about the optics? You have a French president coming, the Brazilian president coming. You have these, tech leaders globally coming. It feels like this is a G20 kind of thing that happened a couple of years ago in India. I mean, is this really a gear shift moment, or is this more about the optics at this point in time? Because we still have to get to that level where we can switch gears from, let's say, second to fourth or something like that.
Yeah, Amitosh, there are very many ways to answer that question. I think far be it from me to say it's not about optics. There is a certain optics to this, obviously. And I do feel that, India in some sense has also picked up on the vibes of the world, I would say. Because we are increasingly in a sentiment-driven global economy. It's always been that way for markets that you talk about, obviously, on your shows. But more so now we're seeing it across the board peter out into the ways in which people allocate capital, the ways in which people think about risk. Because the world is at such an uncertain place, you have to be led by your heart. And to that extent, I think the signal that India is trying to send through summits like this is obviously that we're open for business. The rubber really meets the road in terms of how we follow up in enabling that business environment. And there are, of course, tensions around that, as there would be in any developing country context, where the state capacity to design laws and regulations or enable, businesses to sort of grow in the country, that's always a work in progress.
You've been at the center of the debate around India building guardrails as it builds technology. And I just want to understand, based on this latest example that we've got, direction coming from India, the government tightening these AI content rules, the government now requiring platforms like Meta and Instagram and X to adhere to takedown orders of AI-related content within 3 hours instead of the earlier 36 hours. What are the implications of such moves?
So this is precisely the kind of tension that I pointed to. I think this is the rule-making part of inviting companies into India is really something that requires much more focus at the design stages. The 3-hour window was never consulted on with industry, and obviously that's not good for investor sentiment. Overall, the trend that we see across the world and in India is that AI, because of the uncertainties associated with its deployment, and its impact on societies and markets, is causing a bit of a sort of a panicky reaction within regulatory institutions and state bodies. And I think what we need to do at times like this is go back to first principles and think about really what is the kind of information society that a country, democratic country like India wants. It cannot possibly be the case that because there is AI associated with content being generated and disseminated online, it is for that reason that we need to clamp down on, the online content environment. There have to be better ways to do it. We have to get companies involved. We have to figure out what the incentives would be for these companies to invest in the kind of solutions that can safeguard all of us.
That was Vivan Sharan from Cohen Advisory Group. Vivan, thanks so much for joining us. Really appreciate it. We're counting down to the market open in Mumbai. We're back in just 2. All right, it is exactly 9:15 in India, 11:45 Singapore time, and that's why Indian markets have now come online. The Nifty 50, what's it looking like? Well, it's down. It's down nearly 0.75% at 25,604. There was a conversation going on the last couple of days that we would probably go ahead and touch the 26,000 mark, that supportive figure, but that's not happened, and that could lead to a broader market positivity. In fact, it's dropping even further right now, going all the way down to about 0.86, 89, yeah. 25,583, the market reacting. This is perhaps a continuation of what's happened in Asia, the AI-led crackdown in a sense. The rupee also weakening against the dollar at 90.65. There's a lot that we got to cover. We'll see what the bonds are up to. But let's just give you a sense of how perhaps the earnings might change things around as it continues the parade of earnings. We're looking at mining company Hindalco Industries. The third quarter net profit fell 45%, bogged down by fire-related expenses in a U.S. subsidiary's plant. Consolidated revenue, however, rising 14%, partly due to strong performance in India and firmer copper and aluminum prices. Coal India also saw weaker profits. Consolidated net profit sliding nearly 16% year-on-year, and revenues down about 5%. Now, this slip in line with India's overall demand for power, falling 0.4% in the third quarter. State-owned IRCTC, however, saw net profit grow 22%, driven by a strong performance across its segment. The Indian Rail, that is IRCTC, is up about 0.5%, 0.6 now, and Coal India down 1.8, and Hindalco down about 4%. Now, thousands of Indian farmers have staged protests nationwide against the proposed US-India interim trade deal, accusing the government of compromising their interests. Demonstrators burned copies of the pact, while opposition lawmakers rallied outside Parliament, calling it a trap deal. The protests were backed by the Samyukt Kisan Morcha, which warned that lower tariffs could allow subsidized US farm imports to undercut local producers. Farm leaders warned that the deal would push them into an acute crisis.
And now the latest trade deal with America, that is going to further push into a much more acute crisis. So against that, it is a fight for our survival, and we will go to any extent to ensure that it is successful. Our struggle is successful.
Meantime, Trade Minister Piyush Goyal maintains that key agricultural products are excluded from the pact.
I think that around 90 to 95% of Indian farm products have been kept out of the US-India trade deal. The farm products which we already import and do not harm the Indian farmers have been opened in a calibrated manner for the United States.
Now, the farmers also protesting, that particular protest of the farmers coinciding with trade unions protesting against India's new labor codes. Demonstrators shut markets and transport in several cities. That was disrupted, calling the reforms anti-worker and pro-corporate union leaders. Now, these laws were introduced by Prime Minister Narendra Modi's government, consolidating 29 of the existing labor regulations and weaken worker protections. The government says the overall is aimed at modernizing rules, some dating back to the colonial era, and boosting manufacturing in Asia's third largest economy. The strike expanded beyond bank employees into a broader industrial action led by multiple national trade unions. All right. Well, Samir Kapadia is the managing partner at Vogel Group. He's joining us live from Washington, D.C. And Vogel Group, for our viewers, is an international government affairs and consulting firm headquartered there. Samir, thanks so much for joining us. I really appreciate it. From this, I assume that you're walking the corridors of power in Washington, D.C., and therefore you perhaps know what really is going on when India tries to get answers to so many questions around the India-US interim deal. The first question I have is that when you have Piyush Goyal, the Indian Commerce Minister, basically saying that 95% of agricultural goods have been protected, but initially and before this deal, it was always understood the red line was all of agriculture, the entire 100% gamut. I just want to understand from your point of view, do the farmers have a point, or are they premature in acting when you don't have a full deal yet?
Well, thank you so much for having me, Amitoj. And I think it's going to be the latter. Remember, the U.S.-India agricultural trade dispute and challenges are nothing new. They were a legacy issue that continued to trudge along in some of those immediate negotiations that happened after Liberation Day, where President Trump announced those tariffs. And I think the fact that Piyush Goyal, sir, is saying that, look, 95, 96% of these things aren't impacted, I think we have to take that at good faith. But look, this is an issue about sequencing more than it is about a structural or systemic dispute with the U.S.-India deal. Indians wanted this deal. The United States wanted this deal. Agriculture will be sorted in due time. And I think there's enough measures to remediate anything that might go awry.
What measures? Because based on my conversations with those who are kind of associated with the leadership of these protests, they have indicated that it's a matter of trust, that we don't trust these two governments to make a fair deal for us because we don't know the fine print. So for now, we're just like fearful, basically.
Well, that's a bit irrational. I mean, we have to remember that these are huge economies, huge governments that have just put together in the beginning of this year a framework. And they've already said that it's an interim trade agreement. Remember, that was always the idea between the United States and India, that they'd start with phases. This is phase one, and it's going to go into a much larger bilateral trade agreement as they move along this process. All we know is that there's a joint statement, and this is an important designation for your viewers. A joint statement is negotiated language between the two governments. They both have to agree on it, whereas fact sheets are put out by each government on their own. And usually the audience of a fact sheet are your own constituents, your own citizenship. So in that manner, if the domestic farmers in India are disputing or have challenges around the joint statement, that's one thing. If they have a dispute with the fact sheet that the ministers put out, that's a completely different thing. But I think it's just too early to tell. We can't simply cast aspersions when we've only been a week into the process and we have some documents that are at least guiding in what direction this will go down.
I'm glad you mentioned the fact sheet because you answered my previous question by saying that, yes, it's kind of irrational what the farmers are doing. But that if you have to rationalize it, you have to rationalize it in the context of two things. One is that the fact sheet that you mentioned was changed by the US. Two aspects of that were changed. Pulses was removed, the word, and the commitment that was mentioned in the fact sheet of $500 billion that India would purchase from the US was removed, that commitment word, and it was changed to intents. When the two sides can't get their act together, then how can the farmers trust them?
Well, I don't think that's necessarily fair about governments not getting their act together. I think there has to be a lot of importance put on the exact words around these statements. And so by taking away the word commitment and moving into intends to purchase, I think is more fair. Remember, these aren't sort of procurement orders. It's not saying, India, you must purchase $500 billion worth of goods, or United States, you must only export X amount of this specific product. What they're saying is, this is the framework that we put together, and we're both going to endeavor to meet those commitments. And at some shape or form, if those are not met, then we will go and walk away or amend the tariff structure or any other remediations. This is natural. I mean, even if you look at a merger between two companies, you have to see what both sides are bringing to the table. And if they don't bring it together, a deal falls apart. Very similar. Okay. This is nothing to be feared over.
Okay. Is it also natural that one side claims that the other is committed to stop buying oil from Russia, and that particular side doesn't give you an answer on that, despite repeated questions?
I agree with you here. I think that both governments have to be a little more transparent on how they're going to navigate this. This certainly was not left with any kind of certainty to markets and to other government stakeholders. And frankly, there's a lot of duplicity in this sort of ecosystem. Remember, Europe is a giant purchaser of Russian oil and gas products, yet they're not held to the same standard as the Indian government. That's a bit unfair. And so I totally agree with you. There has to be some kind of clarity on how this is going to go. But if I were a betting man, I think that it's likely that the Trump administration will, in some ways, look the other way and honor current agreements that India has with Russia, which could be long-term fixed contracts with the condition to say, hey, look, just don't sign any new contracts while we're pursuing this sort of end to the war in Ukraine. So could there be a little bit of straddling? Absolutely. Is it good for markets or good for people to have this kind of uncertainty? Absolutely not. They got to clear this up.
Okay. I want your view on the labor code protests also. We spoke about it a little bit on the show. I know this is part of India's domestic policy, but perhaps it does intersect with the US-India trade deal negotiations in terms of labor standards, investor confidence, and global trade compliance. So what's your view?
Well, generally, the United States has been, they like to say they're very stern about labor policies in countries where we have supply chains. But we could be doing a lot more. Remember, over the past 10 years, we've seen, a lot of U.S. attention towards forced labor issues in China. We saw a lot of conditions around the United States, Mexico, Canada arrangement that were not met, where the president and just President Biden, but President Trump were very upset with the way Mexico handled labor policies. I think, let's put it this way. The United States wants to import more from India, and they got to have good labor standards for us to do so.
All right. Well, I'm sure that'll be on the negotiation table. Thanks so much for that. That was Samir Kapadia from Vogel Group. And this was Inside India. Thanks so much for watching. Keep watching.